right. Hopefully everybody can see me. It's 2:02 p.m. And as I said a minute ago, that I do want to be respectful of everybody's time, including our guest speaker. We know often people join a little bit late, and we'll continue to allow participants to join us. So let me begin by starting, first of all, and for those of you who don't know me, I want to introduce myself. My name is Oded Orgil. I'm president of the Canada's Chamber of Commerce, and I'm thrilled to continue to provide these Zoom conferences for our members and guests as we continue to bring you hopefully interesting speakers and interesting topics. For those of you who don't know, the Canada's Chamber of Commerce is a not-for-profit chamber of commerce, and our overall mandate is to help promote bilateral trade between Canadian companies and Israeli companies. However, at different times, and this is one of those situations, it may not be a direct relationship to Israel and Canada, but we feel this topic and this speaker are going to provide great value for all of you and over the next 45, 50 minutes. So I thank you all for joining. And now I want to take a very brief moment, and introduce our guest speaker. Chris Thompson is someone I've known for a number of years. I've known him in a professional and a personal capacity. His reputation on Bay Street is tremendous. He's got a long history in research, second generation research, right, Chris?
Yeah.
So it's kind of in his blood. He is the president, I think, director of research and owner of eResearch Corp. He specializes in a lot of the small cap spaces, commodities, and again, he'll talk a little bit more about some of the other areas where his company is good. And we're thrilled to have him aboard today. And what we're going to do is talk from a high level, a little bit about gold, opportunities, education, how to do it, what to do it, and maybe some comparisons to other asset classes. So again, Chris, thank you very, very much for joining us. Thank you, everybody, for participating. If you have any questions, Lior Abramovich, who's our Director of Corporate Development, is in the background, and you can just chat your questions. I will try to politely interrupt Chris through some of his presentation if the questions are important, and we want to make this as much as possible an interactive opportunity for all of us. So without further ado, Chris, I'm going to turn it over to you. I know you have a short presentation, PowerPoint that you can share with us, and then we'll get into some of the questions. So over to you, Chris.
So how do I pull it up on my screen then?
Okay, hang on a sec.
You have to give me control or something?
I'm going to make you the host. There we go.
Okay.
And you should just be able to share the screen with all of us.
Okay, so let's see. I'm going to share this screen. So hopefully that's going to come up.
I think we're in business. We're in business.
Yeah, you can see it?
Yep, absolutely.
Okay. Good morning, good afternoon, or good evening. Welcome to the presentation, wherever you're coming from. Hopefully it'll be informative for you. As Oded said, and thanks, Oded, for inviting me to present. I always like to share my knowledge with investors. As Oded said, my name is Chris Thompson. Okay, I'm just trying to advance the, there we go. Oh, yeah.
There you go.
Always the disclaimer, right?
Right.
We're good? Okay.
Yeah.
Just, as Oded said, I'm Chris Thompson. I am the president and director of research for eResearch. I'm not an investment advisor, so this is why we have the disclaimer. So always consult an investment advisor before you make any investment. Just a quick review of eResearch. It was founded in the year 2000, and we provide institutional quality equity research reports both on companies and on industries. And we try to focus on companies with near-term catalysts that will, not currently reflected in the stock price. I bought the company in January of last year and have written many research reports over the last 18 months. But included in those research reports, I've wrote a number of research reports in the mining space. So I wrote an industry report on the niobium, one on project generator companies. I did a fun report on invest like Eric Sprott, who's a very well-known mining investor. so people who want to follow his lead. And we also have written 3 company reports highlighting 3 mining companies in the space, as well as some other reports I read on technology and industrials. So I've got a good background in the mining space. I come from a mining background, a mining family, and I've been investing in mining companies for over 30 years. So we're here today to talk about gold investing, why you want to invest in gold, and different methods for investing in golds. And we want to look at the gold market as well, because that's an important part of trying to figure out your timing on making this part of an asset class in your investing strategy. So we're going to do a quick review of some of the miners in the space, what's the difference between a junior and a senior, other ways you can invest in mining companies without picking individual stocks, and we'll briefly touch on things like options and futures as well, which are more leveraged products. And because of the comparisons in the market these days between gold and cryptocurrencies, we'll briefly touch on that and show how there's certain similarities between those two asset classes, and talk about some of the pros and cons and the risks, which are always important. You know, there's always a trade-off between risk and reward, so you have to always be aware of that. Why gold? What makes gold so special? When we're looking at the gold as an asset class and an investment, it's been around for thousands of years as a method of payment. When humans moved past the barter system and looked for some ways of doing transactions, you know, various metals were used, gold, silver, even copper were used as ways to do transactions. You know, doing a medium of exchange. Currently, right now, you know, gold is one of these liquid assets. So you know that if you require it to have some sort of value right away, you can sell it and get some cash if you need it right away. When we're looking at various monetary systems right now, gold is often the opposite to what they do. So as they print out more money, gold seems to be able to hold its value. And in the current you know, environment with COVID-19, a lot of governments are struggling with the actual economies, and you know, we could be moving into a combination of a recession plus a government stimulus, which could drive inflation. And so people are looking at you know, how are they going to handle that? And gold is one way of looking at it. And I'm going to
Chris,
go.
if I can interrupt you just, and I'm sorry to do this if I may, really quickly. And so theoretically, I guess what has historically been the value of gold is really because there's a scarcity value to it. Is that really it? There's no arbitrary reason why it isn't gold or platinum. I guess platinum is another, but and that's the theory, that there's just not a lot of it, so therefore it's worth something.
Yeah, and that's a good point to make, because when we talk about the cryptocurrencies later on, we talk about a scarcity as well. So I think it has to do with the value attributed to it based on its availability and people's desire for it. So it's a combination of both. But one of the factors for its actual price is the actual scarcity of it, you know, and how much of it is, you know, on the Earth's, you know, crust, and how much we can actually get out. And people have just used it. And as I mentioned, you know, it's gold and silver and even copper are some of the metals that they use for trading in coins early on. You know, nowadays we have some, you know, platinum and palladium, which are also used. But yeah, it has to do with a combination of desire and as well as scarcity itself.
Great. Thank you.
And that's what, you know, when you look down at the slide, we're talking about a demand and supply, you know, potential imbalance right now. Demand coming from, you know, central banks are actually buying golds because they're actually worried about, you know, various currencies and devaluation of currencies. And people are looking for ways of buying into gold. And one of the ways, which we'll talk about later on, is these exchange traded funds. And so they're having to purchase gold to make up for the fact that investors are buying into the ETFs. And then when we talk about the supply problem, it is, we talk about scarcity, right? The value is due to the scarcity.
Right.
And right now, the easy gold is gone. And that's what they start talking about, meaning that, the near surface in easy mineable locations, you're going to have to go further inland, higher costs. Higher cost means that, companies will not operate unless they can get their money back. A second part of that problem is on the investing side is, 10 years ago, 20 years ago, there were a lot of mining funds that would invest in junior companies. And the junior companies are the ones that drive the search for the new deposits. Mostly the senior companies are focused on their production, with the junior companies looking for the next asset. So, and again, that's, you have to figure out how these companies are being funded. And when we're talking about the current state of the economy, my last bullet point there is, where is the money flowing? And people in this situation like to sometimes go after hard assets, things like real estate, commodities and energy, and that because they can get their hands around them. And one of the commodities is gold. So looking at the gold price, and I attended a presentation at PDAC last year, and this slide came up, and I borrowed it from the World Gold Council. But if you're looking, long term at the gold price from 1970 to 2020, you are looking at 3 different regimes. When after the war, there's an agreement called Bretton Woods, which pegged some currencies to gold, and the U.S. dollar was one, and it was the U.S. gold standard, it was called. And that's when they pegged the U.S. dollar to a certain amount of gold. So if you wanted to exchange your dollar for gold, you could. In the 80s, they went off the 70s, they went off the gold standard. And when that happened, you had your first little bump in the price of gold. And during that time, from the 80s through the 2000s, you had a lot of central banks selling gold and also trying to control inflation, the high inflation of the 80s. And so that sort of leads into the 2000 time frame, where we have our next regime, and currently it's it's coming up, and you're seeing now that it's sort of let loose. The price of gold has spiked from $500, and it's gone above 1,500, and even hit 2,000 more recently. And you've got things in the third regime, as I mentioned before, the gold ETFs buying gold because people want to have a gold investment. And now, in fact, you have central banks are also buying because they're worried about currency devaluation. So they're trying to make sure that they have a hedge in there with some gold themselves.
So Chris, if I could, sorry to interrupt you again, if we can go back to that, if I could read into what you're saying there is, and I don't want to speak for you, but that you're saying this probably third regime is not over for a variety of reasons. I think you're going to talk a little bit more about that, but based on the fact there's no pegging, there is now not a fight to sell gold. There's probably potential some inflation issues, and banks, if anything, the momentum is still behind gold in the future. I think you'll talk a little more about it, but I'm just trying to get
sorry, and that was a good point. I should have gone further on that, but the regime 3 is that I don't think we're at the top yet. And if you look at one of the famous expressions when you're being a chartist is the trend is your friend. And if you're looking at that time from 2005 to 2020, you definitely see that there is an upwards trend in the price of gold. And I don't think right now there's anything that's going to stop it from moving forward. And so, but that's a good point, though. I don't think we're moving into regime 4 quite yet.
Okay, thank you.
But and part of the reason, we discussed earlier supply and demand. So, here's the supply side of the equation. This is 2008 through 2019. 2020 isn't over yet, but you'll notice the bars are the actual production, with the line chart is the actual year-over-year increase. And you can see, from 2008 through 2013 and 14, you had some, 3 to 7% increase in yearly production as the price of gold has been increasing. Producers are trying to generate more revenue, producing more gold. But you'll notice that, you know, in 2018, we sort of had a peak there, and now we started to pull back. So 2019 was the first year since 2008 where there was actually a decline in production. So again, we're just looking at basic economics, you know, your supply and demand. So the next one, of course, what I want to look at is the actual demand. And this comes again from the World Gold Council. And most people don't really understand that. Now, you might not be able to see the colors on my chart, but the purple, the big purple bar is actually jewelry. That is the largest demand right now for gold, and it's been historically over the last few years. And it ebbs and flows a bit depending on the price of gold. The more gold, the higher the price of gold, the less amount of jewelry consumption there is. But you can see from the other bars, central bank buying, as I mentioned before, which is the very bottom bar, which is the purple. You can see in 2018 and 2019, there's been definitely an increase in central bank buying, and as well as the green bar is investment. And it's been fairly steady for the last few years, with technology being the other one. And technology is the use of you know, gold posts and certain you know, computer chips and electronics manufacturing. But the demand
Chris,
is quite.
sorry, quick question for you. I apologize, and again, I'm sorry. I hope it's all right. I'm going to just
Oh
continue.
yeah, no,
to
for
in.
sure. No, I like the interaction for sure. Yeah.
Okay.
Nope.
And I would also say, again, for anybody who's on the call, please, if you have any questions, jump in. As I said, Chris has been very amenable. He'd like to hear from you. My question is, I don't see much of a difference. I know you said jewelry is a function. So I think obviously more people on the earth, more jewelry demand.
Yeah.
It doesn't look like it's moved in relation to how strong the economies are. Like, can we read anything that, again, this past year is COVID. Obviously, it's been horrific. I mean, there is going to be, incomes are down, arguably worldwide, or they will be. Do you see that having a major impact?
I do see that in 2020, and I should have put up a quarterly chart,
Okay.
but the quarterly demand from the World Gold Council does show a drop-off for this year. So you will see a drop. I think it's below, you know, it's typically like the scale on the left-hand side is tons. You know, a typical year right now we're averaging sort of over 4,000 tons a year in demand, which is about 1,000 tons a quarter. And that has dropped below 1,000 tons for the first couple of quarters of this year, just from the current economy. So that is correct. Yeah.
Great.
But there is, I think, if I looked at the chart correctly, I remember it, there was a slight increase in the gold investment side, but it didn't, you know, help with the drop in the jewelry consumption. Looking at now this chart, for those who are looking at mining stocks, this is looking at the market capitalization of mining companies. And again, this is just showing the trends, you know, since 2008, and what we're trying to look for, you know, for the mining stocks as the price, you know, has rebounded over the last couple of years. You see the market capitalization. So there's a direct correlation between, you know, the price of metals, and there's an index metals price is the top wavy line, right? And the actual market cap of the companies is the bar chart. So you can see as the prices recovered at the end of 2015, you know, you will get an increase also in the market cap of companies. And there's a direct relationship and often an accelerated relationship between the prices of the commodities and the actual mining companies, because it's leveraged to the amount of resource in the ground. And I'll talk about that in a minute. And again, we're trying to look at trends here. Like, what are we seeing here in the marketplace? Is this gold trend continuing? And so this is looking at, you know, the bull and the bear markets versus where gold is. And the bull and the bear markets, the recessions are the gray bars that you'll see, and the bull is the gold and the bear is the blue. And you can see right now that we're, you know, sort of in the beginnings of it looks like another, you know, a bull market in the gold space. If we, you know, we've had one for about 53 months. The last one lasted more than 125 months. but it looks like we may be at the beginnings of a major trend in the gold space. Now talking about pricing, so this is where people say, well, what's the price going to be and how do you figure it out? Well, this is a company called Increntem, and they've done a model, and they've done models for the last couple of years trying to model out their probabilities of what gold is going to be in the next 5 or 10 years. And in this case, this came out of their recent report, and they use factors based on the current money supply and the gold coverage ratio, which is the amount of gold the US government has versus the amount of currency it has outstanding. And they do a probability ratio. I don't know if everyone knows their mathematics, their statistics that we had to take an MBA class, but they look and they figure out that, they run this model and they're looking at, they're in that gold box there, their probability weighted peak is around, $40,800, almost $5,000 US per ounce by 2030. And that's based on, the combination of money supply, central banks printing money, as well as the current supply and demand in the marketplace.
So Chris, I'm not going to hold you to this, but what you've sort of rationalized, correct me if I'm wrong, in the last 2 or 3 slides is there's a variety of factors, and we talked about a couple, both, again, the different tiers or stages in the world from a global macro perspective, from maybe a technical perspective, and now from an MBA quantitative analysis perspective.
Yeah.
That really just sort of set the table, and you're not calling a price of 4,800 or 45 or 10.
No.
But you're just saying all these things bode well for someone to consider start adding some gold component to their portfolio.
Yeah, and you have to look at, the previous slide where we looked at the trend is, what is the actual trend right now? And it definitely is an upward trend. And this just, the mathematics behind it is still pointing to the trend. And when I worked as an equity analyst and worked with other analysts in the field, one of the things that they got criticized on was saying that, that price never reached the price target you had in your report. And the analyst would always come back and say, well, my price target is a direction, right? It is, and the difference between the current price and my price target is the strength of my conviction. If I put a little bit of a difference, it means I don't really have a strong conviction it's going to go higher. If I put a lot of a difference, it means I have a strong conviction. So, did it meet my price target? Maybe not, but, did the price go up by 25 or 30%? Yes. Okay, well, that's really what you need to be looking at. And I think that this is what I tried to cover off through different scenarios is that, looking at each of the charts, it's clearly showing that right now we're in an upward slope. And so we're looking at, probably gold, being worth more this time next year than it is right now. And if you look at what's happened in the stock markets, which I'll talk about in a minute, the stock prices on some of those companies have gone up by 20 to 50 or more percent. The juniors have gone up, some of them have gone up by 100% because they're more highly leveraged. And I'll talk about that right now, if you don't mind me segueing into it.
No, please.
So we're talking about, mining companies and what you want to look for in an investment and what your risk profile is. And so just want to set the table with, how we look at companies in the mining space, equities, and how we try to value them a bit and in the risk profile. So, the top level, you have the senior mining companies, which are typically in production, the mid-tier companies, which are either in production or maybe near production. Typically, the seniors have multiple assets, often in a couple different countries or geographies. Mid-tier typically have one, maybe 2 or 3 assets. Junior exploration company, there's no production, so there's no cash flow, and usually they're a single asset or a dual asset, so they're a little bit higher of a risk, which we'll talk about. But each one of these is actually leveraged to gold because you only pay, the value you assign to it is only valued based on the ounces they have in the ground. And as the gold price increases, their costs are fairly fixed. There's a huge leverage to their operating margins as the price increases because they're running their mines right now or looking for their projects at certain fixed costs, right? Now, when we're looking at assets in that space, it is the resource which gives the company value. For the seniors, the resource leads to production, leads to cash flows, often leads to dividends, which is important for a lot of investors who want to get the dividend income. And just to give you a high-level resource, which is important, in Canada we have a system, and it's called the NI 43-101, and it's important because there's different classes of resource, from proven and probable to measured and indicated and inferred. In the top category, proven and probable, those have some economic value, and they're usually part of some sort of feasibility study or preliminary economic assessment. And so they typically carry a higher weight when you're trying to compare companies. And it's important when you're looking at valuing assets that they have a good resource, and it's an economic resource. Other things that can adversely affect companies and assets they're trying to exploit, is management. Have they done it before? Have they had success either finding economic deposits or getting them into production and making money? Politics. I can't stress this enough. Location, the famous, real estate term. When you're looking at assets, what sort of jurisdictions they're in. The Fraser Institute publishes a report every year, and it ranks every country and region for their mining friendliness. Things like Alaska or Finland or Nevada typically rank high. Same with Canada. Australia typically ranks very high. In South America, you have places like Peru and Guyana, which are places in Chile which are ranked very high for mining and production. Some other regions, you have to be careful. There's geopolitical risk. In this current environment with the depressed oil prices, energy costs can sometimes, for remote locations which aren't on grid, you're having to use diesel. So currently right now, a lot of these gold companies are liking the fact that energy prices are down. And again, it's one of their largest costs, especially in the remote locations. Currently, they are working on things like, small scale nuclear plants, but those are still way off and have a lot of, political and environmental concerns as well. Things like, infrastructure and transportation, like site access. We talked about this before. A lot of the easy gold is gone. They're having to go further in field off the grid and off the transportation network to find these deposits. And they're much harder to mine, and they're much harder to process. When we're looking at production, has the company sold any of their production forward, which they can do to raise cash, or they sold royalties on the land? Also, things like the debt and the share structure are equally important. If there are too many shares outstanding, it's very hard for an investor to make money if there are, say, 100 million, 200 million shares outstanding versus like 20 or 30 million, for a junior exploration company.
Chris, it goes without saying, again, obviously that the seniors are somebody, again, they're more stable, therefore you're not going to see them, maybe the big bang for your buck. You talked about that. There's a leverage opportunity with the little ones. Are there many instances, again, in my limited knowledge of this, are there many instances where companies go from being a junior to a mid-tier or senior, or do they almost inevitably get bought out, by one of the big ones they strategically partner?
Yeah, no, I mean, there are a lot of the junior, over the last, I guess, probably decade or so, a lot of the juniors have become the de facto exploration companies for the seniors. And so you will see a lot of the seniors buying up the juniors in that case. But, the reason why there are mid-tier companies out there is that there are some ones who do come together, who do see the scale. Sometimes it's by a region, or sometimes by similar asset classes. They get together for some synergies. You might see a combination, say, in a South American country where they're buying up assets. Maybe because they have one mill and it makes economic sense, and then they become a mid-tier. So typically the juniors are bought up before they get to production. Only once in a while do they make that leap from a junior to a mid-tier, and often it's during, to become a mid-tier is often during a combination or a merger between 2 or 3 companies itself.
Yeah. And if I could ask one more, I mean, I know you alluded to, again, obviously there's the tier 1 locations for exploration. I think you mentioned Nevada, Alaska, Finland. You did talk about some emerging worlds, and again, I think you mentioned there's 2 or 3 places in South America. You did, I didn't hear you say much of Africa, and I assume, again, you're talking about there's some political stability.
So Africa, South Africa is a big place, a good mining jurisdiction. A lot of West Africa is also fairly safe. You do have some, a turmoil right now in some of the West African countries, but like Burkina Faso has, some recent issues, etc. So, but West Africa is a fairly secure place. There are a lot of, Canada has a long history of developing assets in that region. There are, like, as I said, in Europe, Finland is a very a good place, Portugal as well. And then some of you're talking about some of the, the countries like in the Balkans, they also have a very favorable mining jurisdiction. Some of those areas are still sort of recovering from the post-Soviet era mining jurisdictions. And so, but, I think as things progress along, with economies looking for jobs and income, they'll come on board faster.
Great, thank you.
I just wanted to talk briefly about royalties and streaming companies. This is an asset class which has come up over the last 20 years where companies are purchasing, typically when you're an exploration company, maybe even a geologist, and you have a claim and someone wants to work your property or take it over and do exploration, you might obtain a royalty on it, maybe a 1% royalty on it. And this has become now big business where people buy these royalties and form these companies. And also mining companies, when they're looking to raise capital these days, they actually will sell a royalty to an investing company who will pay, $10 million, $50 million, $100 million for royalties, depending on how far the project is along. Part of the advantages of these royalty have low overhead. They have a few people in an office who evaluate the projects, a lot of geologists, and they, because they're getting a 1% production as the mine comes into production, and if the company wants to produce more, they actually can make more money out of it. And I just wanted to mention a couple of them, like Franco-Nevada and Wheaton Precious Metals, as being 2 examples of another way you might participate in this market without having to invest in a single company itself. Other investing strategies in this area, and again, we're talking about funds. There's different types of funds. It used to be gold mutual funds was a way to diversify your risk because they had a basket. A lot of that money has moved into now these exchange traded funds because of the low fees. And like, for example, the Van Eck one, it actually mimics the basket of the NYSE Gold Miners Index. And so you can actually buy this exchange traded fund and get a basket of actual companies and without having to own them yourself. So it's a bit of a diversification. But if you actually want the gold itself, you can actually buy an ETF that just invests in the gold. And the most popular one out there is the Spiders Gold Trust. And this one just buys physical gold or gold certificates. And that way it's a one-to-one relationship between the price of gold and your actual return. Now, other things which are higher risk are the derivative products, where you can put a little money down and you can either buy options or futures on gold. And I'll go through some of the pros and cons a little bit later, but these are higher risk. These are more, and I'm thinking more like a gambling than an investing strategy. But it's well worth talking about them, and I have them in the pros and the cons, so we can sort of go through them. And then last but not least is the physical gold itself, is the bullion, is the coins. There's a lot of people out there who believe in buying these gold coins and having the small gold bars, and that's another one of these investment strategies to have it. and like, you know, buying a gold ETF, the amount you're going to gain is just going to be from the actual gain in the price of gold, which is not leveraged as some of the equity products are. And just as a reminder for those people, you know, who are looking for something in the life cycle of a mining company, you know, the left-hand side here, we have, you know, the exploration companies. On the right-hand side, we have the operating mine. And so, you know, one thing I wanted everyone to be aware of, you look at the timeline, you know, from beginning of when you put the first hole in the ground to the time you have startup, you know, it can be 10 years, right? And so you have to remember that there are ebbs and flows when you're investing in these companies. And the general chart that's just trying to show you is that, you know, there's always the hype. Sometimes the hype outruns the actual return on the company for a while. And so if the company is going to have, you know, get it into production, there may be cycles in the actual price of the stock, and you just have to be careful not to sell out too soon. The top part of that also goes through the risks, what we're looking at, and it's always important to look at the risk, you know, fluctuating commodity prices, you know, the funding risk, you know, can they get funding all the way to production? To technical risk, things like, you know, can you actually process the rock in an economic manner to actually get the mineral out? And then the exploration risk is, you know, can you actually drill enough holes and get enough of the ore body to make it economics?
Chris, I don't know if you're seeing, we've actually got a very interesting discussion from a question and then a follow-up to it. You know, one of our guests is that,
I'm not
okay, I'm happy to read it.
Yeah, I'm not seeing any of it. Let me see if I can get the Q&A up on my screen.
Sure, just if you hit participants perhaps, but it's really just asking that they've been tracking, one of them's been tracking the technology that converts gold from into gold from volcanic rock. Yeah. Are you aware of this? Are companies using this technology? And then someone else commented that they're aware of this trade process, but you have to be careful about scams. I don't know if so just wondering if you're aware of this, if you've seen this out there.
I'm not, yeah, sorry, I'm not seeing, I just clicked on the Q&A, but nothing's coming up on my side, so it must somehow be linked to you guys only.
No worries, I'm going to try to make sure
yeah, I don't, there's various ways to find and process gold. I'm not really sure about the volcanic, I mean, there are volcanic, something called a VMS deposit, which is volcanic massive sulfide deposits. It's a type of gold. There's various types of gold deposits. Some are placer, which means that they're disseminated in gravels. Sometimes it's orogenic, and sometimes it's in quartz veins. But there are VMS deposits, which are volcanic massive sulfides. Now, I'm not sure if that's what he's talking about, or if there's something new, meaning that they're processing a certain type of rock to get gold out of it. But I haven't really heard of that being, you know, typically, you know, gold is either disseminated in something or it's in a vein. You know, it's often a fluid replacement. And so it's the rock, it's the age of the rock, and it has to be a certain age and place where the, you know, they have actual, the fluid has been replaced and the gold is there, or the gold has been washed away from somewhere and it's been deposited in like a gravel or something. So,
yeah, no worries. What we'll do at the end for anybody is we'll ensure that they have your contact information, so that if anybody does want to follow up with Chris, you know, if they've got specific questions. But yeah, thank you. Like, let's just carry on and go from there.
Yeah, and I just wanted to briefly, you know, I'm aware of time here, and I just wanted to talk about gold, cryptocurrency, because, you know, similar to gold, it's now come up in a lot of discussions with gold. You know, do I invest in a cryptocurrency? It's very similar to like a gold, because, you know, especially like Bitcoin, where there's a limited amount, it's a limited resource. And basically, you know, the definition is right from Wikipedia. You know, it's a digital asset, which works as a medium of exchange, you know, very similar to any sort of currency out there. And all it is it's basically done through technology using a digital ledger, which is called the blockchain, to basically keep track of the transactions, both the creation of the coins as well as the transactions. And so, you know, it's a way of, you know, again, it could be it's another asset class in itself. I think there's room for it in anyone's portfolio, similar to gold, but I don't think it should be necessarily, you know, competing with gold for your asset classes. Now, with that being said, you know, interestingly enough, there are things called stable coins, which, you know, are created by linking it to some sort of other cryptocurrency or money or commodity. And so, you know, it's interesting because, you know, in the next slide, you know, I talk about, you know, Bitcoin and Ethereum are the two sort of main cryptocurrencies out there, but some of these stable coins like Tether, you actually have it backed by, in this case, one by the US dollar, but there's actually a Tether Gold, which is actually linked to the physical gold. And in fact, when in doing the research for this presentation, I found there were 30 other cryptocurrencies that are linked to gold. So it's interesting out there right now. And the big news, right, that's also in the stable coin is that Facebook is leading a stable coin that is also backed by a major currency. They see as it's called Libra, and they see it as being a way of doing transactions, you know, through the Facebook network and earning revenue. So, you know, definitely when, you know, places like Facebook are going to be using the currencies, you know, they believe that it's the future for some of these, you know, for some of these online transactions might be done using cryptocurrencies as opposed to real currencies, especially talking across a global network, right, where you lose money on foreign exchange dollars, etc. I'm just aware of the time.
Before we go on, I just want to say, for the purposes of full disclosure, I mean, Chris never presented himself as a crypto expert. It was my impetus in pushing him on the line of how do you compare Bitcoin or other cryptocurrencies? Because I've heard it, and I have a bias to believing that Bitcoin is effectively a crypto gold, that although it is a currency, you can transact, theoretically you can transact with gold. It's just both of them are somewhat cumbersome. Bitcoin is a little easier to transact, but I viewed it, and you look at the numbers out there, most people use it as an asset class tool. I think a good, what I got out of what your conversation is right there, Chris, is that it doesn't compete with gold. It is another asset class. And again, it moves differently. I've watched it, I'm sure like you, that it doesn't move necessarily in conjunction, or perhaps it does with the stock market or with gold. These are all very different. And again, speak to your advisor, and there's people out there who can help you, you know, allocate appropriately in your portfolio.
Yeah, I agree with you. And the fact that, you know, when we're talking about, you know, either mining companies or physical gold, you know, I think that's more of an investment. I see cryptocurrencies as being more of a lifestyle transaction. If you're part of that in the ecosystem and you are transacting, you know, using cryptocurrency is an easier method to operate, especially in some of these online environments where you may be exchanging goods and services. It's easier to hold the cryptocurrency and trade in those ones. Really wanted to, you know, it's getting close to 40 minutes now, so I wanted just to hit on, there's just two more slides of the pros and the cons and the risks. I touched on them all these ones throughout the presentation, but producers, you know, at the top of the chart there, you know, any sort of the equities that's going to have the same type of pro, being, you know, easy to acquire, highly liquid. These are investments you can get in and out of. The problem with when you move into the juniors, like the explorers, sometimes there is a risk to get out of the asset if it's thinly traded. If you've bought too many shares, you know, if it only trades 10,000 shares a day and you have 1 million shares, you know, it might be hard to get out of it. You know, it could take you a couple of weeks to get out of it. So you got to be aware of that. On the producer side, you know, there's always your operational risk. There's always the capital cost, you know, how much they have to keep on funding these big projects to keep them moving forward. On the explorers, there's always the exploration risk. Can you actually get, you know, the deposit to this size where it can be economically viable? When you're looking at the gold ETFs that own a basket of equities, in this case, not the commodity, but equities, you know, you have it's basically you still get the leverage to the resource, which you like, but you have that diversification. Although you do have, you know, the cons, you do have some annual fees, but typically the the management ratio on the ETFs is quite low. So, you do have sometimes some operational risk with your, the explorers themselves or the producers in the basket. But, by having that basket, it helps mitigate things. On the commodity side, the issue with having the commodity is you just get the return based on the commodity, not on the underlying equity. So it's not as leveraged. When you're looking at the royalty and streaming product, these are often dividend paying ones as well, similar to the producers, because they're getting cash flows. And you get diversification because these royalty and streaming companies have multiple assets, multiple streams that they're getting from, and they have low overhead costs. So they have a high return on their actual number of employees. But you do have it that the fact that, sometimes they are buying these royalties, 5 years, 7 years, 10 years before the companies go into productions. Looking at the options in future, you do have the pros. You can put a little bit of money down to get these contracts. They are liquid, but they are highly leveraged. And they're also time sensitive, meaning that you typically will buy a future contract for a month or 30 days or 60 days or something like that. So you do have the ability to lose all your investment. And if the commodity goes the wrong way, sometimes you're on the hook for that downward change as well. With physical gold and jewelry, you have direct ownership. It's easy to get nowadays. There's various online accounts you can set up. With the physical gold, you're only going to get the upside based on the change in the price of gold. You're not going to get that leverage bump that you will get with the mining companies. And with jewelry, there's always the trade-off between the high markups and the purity, which means when you're buying jewelry itself, there may be only a little bit of gold in it, and you're buying like for the style, so you have to be careful. There is a Canadian company that I should mention. It's called Mene, M-E-N-E, and they are a publicly traded company. And what they do is they do gold jewelry by the weight of the gold. And so that's an interesting one you might want to have a look at as being a part of your gold investment strategy. So, and then, I just want to do this chart, with the risk and returns. When you do, and it's like with anything, you higher risk, higher return, lower risk, lower return, right? And so, the futures and options, they're leveraged products. You can make a lot of money, you can lose a lot of money on those ones. As you go through the mining companies, you have the juniors where you get sometimes your biggest bang for the buck. A lot of them have gone from, 10, 20, 30 cents to 90 or $1.20 these days with the current run up in the gold prices. The major mining companies, you get your more stable production, you get cash flow, you get dividends. And so you're lowering your risk, but you're lowering your upside, but you could be getting dividends out of it. And then at the bottom is the bullion ETFs, or the coins or the bullion, where you can actually just buy the gold and you get the actual return itself based on the change of the price of the gold commodity. And that's me. So that's my quick run through the gold space. If you want to reach out to me, that's my coordinates. You can email me if you have questions. If you go on to eResearch.com, all the research reports we do are available there for free. We have research on, mining companies, technology, and you can, you can send me questions if you have them about, specific companies or other industries.
Great, Chris. Before we wrap up, we do have one more question that's come up. Someone has asked, what are ETFs? Perhaps I'll allow you to explain exchange traded fund ETFs. Yeah,
an exchange traded fund is basically it's a fund set up by a third party, and what they do is they buy a basket of equities, and I'll talk about an equity exchange traded fund, but it's basically a fund of companies that they buy to try to mimic some sort of index. In this case, the one I mentioned earlier, there is a gold index which tracks stocks itself. You can't actually buy the gold index, but you can buy the companies that make up the gold index. And what these third-party investing companies do, like a BlackRock is a good example, or a VanEck, what they do is they create these funds, buy all these companies in a portfolio to mimic the index and then list that fund on a stock exchange so you as an investor can buy into it. And sometimes these funds are equities, and sometimes these funds are commodities, these ETFs. And so you just have to be careful of what you're actually buying. Sometimes they can be a leveraged ETF. And it's important to know, and a leveraged ETF means that they're buying equities as well as options, so that if the price of gold goes up, you might get a 2 times bump on the actual return of your exchange traded fund.
That's great. That's a great summary, and I hope that answered the question for this one participant. I wanted everyone to know that Chris and I had a conversation before, and he's again been very professional and succinct. By the way, the panel, the participants said thank you for that. It was a great explanation, Chris. But Chris and we talked about trying to have this event in under an hour. He's done an amazingly professional and succinct job, and you've done so well that we've only had about 3 or 4 questions. So, Chris, thank you. I mean, very much appreciate you coming on and talking about this. I'm going to give everybody one additional plug before I summarize, is that Chris's company is not just a gold or mining research company. They deal in a lot of different and evolving and emerging different areas. So feel free, go on to his website. We may be bringing one of your other research analysts back at a later date, Chris, or you, to talk about other sectors, that I think are of great interest, for our members. So I want to thank you for joining us. For everybody on the call, just so you're aware, we are recording this, and we will allow, whether if you want to hear it again or if you've got someone else that you want to forward to, we'll be sending you out a survey. So again, if you can complete it, we'd like to hear how we're doing, if you found this of interest or not. So please complete that. And over the near term, expect, we've got a number of different other events and other things that are coming online. So I want to thank everybody for participating. Chris, again, thank you so much. Appreciate it. Look forward to it. And for everybody on the call, Chris and all our guests, please stay safe, stay positive, stay healthy, and we'll look forward to seeing all of you again.